video in this little series about different insurance products. Whole life insurance, permanent life insurance, as they say. Whole life insurance is fantastic. It's expensive, but it's expensive for a reason. Whole life insurance, or permanent life insurance, is designed to be there until someone reaches the age of 120 or 121, generally depending on the carrier that you're working with. Plans have so many options. You can do a 10-pay, which means you pay the plan up in full in 10 years. A 20-pay, you pay it in 20 years. To age 65, meaning that they calculate your payments to have the plan policy paid up in full when you turn 65. So when you retire, you don't have to worry about that. It's in place. Your family's got it. Yada yada. Other things that they use whole life insurance for, collateral for loans. Whole life insurance, because it builds a cash value, can be used as collateral for loans. You can use the cash value in your whole life insurance policy to borrow and not even go to the bank. We started doing that with our own whole life insurance plans, paying off credit cards and repaying ourselves the same amount that we would have had to pay the credit card. You've got to make sure your plan is set up correctly. If you put too much money into it, it will become taxable. So you want to make certain that it doesn't get converted to a MEC. If you start getting close to that amount, talk to your agent, add another plan. Whole life insurance, it's what the rich use to move money around and reduce their tax liabilities in retirement. Here's the real reason that whole life insurance is more expensive when compared to term. So the cost of life insurance goes up every single year that you have the policy. Life insurance is purchased with your age and with your health. And that being said, the cost of the insurance increases every single year. Now, in term insurance, they will take whatever period of time that is. Say it's 10 years. They'll overcharge for the first 5 years, undercharge for the next 5 years. Then at the end of that period, it just jumps up. Whole life insurance says, okay, we're going to age 120, so the cost of insurance in those later years will become so prohibitive that nobody could afford to keep it. So what they do is they start building up a cash value, reducing the amount of insurance that the insurance company actually has to provide. That cash value provides a buffer for the company to keep the costs down and manageable, so that people can continue to afford it throughout their life. It doesn't matter what policy it is. It doesn't matter anything about whether it's term, whole, the cost of insurance is going to go up every single year, regardless of the kind. That's an internal mechanism of the policy. That's how it works. Now, that higher cost of that whole life insurance is building that cash value again to reduce the amount of insurance that you're purchasing as you move forward throughout the years.